Think about it. A single 3-digit number determines your mortgage and credit cards. In the United States, that's your credit score.
Whether you're applying for a loan or renting an apartment, lenders use your credit score to measure risk. It is a numerical estimate of your creditworthiness, and higher scores generally indicate lower risk. Many commonly used credit scores range from 300 to 850. In general, higher scores can improve your borrowing options, though lenders also consider other financial information. A credit report may include payment history, credit card balances, loans, and other accounts. Lenders use this to assess if you're likely to repay loans on time. A stronger credit profile may help you qualify for better loan terms, while a weaker profile can make borrowing more expensive. Understanding how credit works is the most valuable personal finance skills, no matter your age or income.
Next, we'll break down the 5 major factors that influence your credit score and explain why some behaviors matter more than others. Credit scores aren't random. They are influence key factors that reflect how you've managed credit over time.
One most important factors is your payment history. Consistently paying bills on time shows lenders you've managed credit responsibly. Missing payments can have a negative impact, especially if they become a pattern. Another important factor is credit utilization, the percentage of your available revolving credit that you're currently using. Experts suggest keeping it low because it affects how lenders view you.
Of your credit history matters. Older accounts hide more information. They show lenders your long-term financial behavior. Applying for several new accounts may signal higher risk, so apply only when necessary.
Credit mix refers to the variety of credit accounts you manage, such as credit cards, auto loans, student loans, or mortgages. A diverse history may provide about how you handle different types of credit. Factor tells the whole story. Credit scores are based on the overall picture of how you've used and managed credit over time. Now that you understand what influences a credit score, let's explore how someone with no single factor tells the whole story. Credit scores are based on the overall picture of how you've used and managed credit over time. Now that you understand what influences a credit score, let's explore how someone with little or no credit history can begin building credit responsibly. Everyone starts somewhere. If you've never borrowed money before, you may have little or no credit history. But that doesn't mean you can't begin building one. One common way to start building credit is with a secured credit card. This typically requires a refundable security deposit. Isn't spending more, it's using the card responsibly and paying the balance on time whenever possible. Some people build credit by becoming an authorized user of a family member's credit card account, depending on how that account is managed. Some financial institutions also offer student credit cards, designed for eligible college students. Setting up automatic payments can help you avoid missed due dates and build a positive payment history. Using only a portion of your available credit and avoiding large revolving balances may support healthy credit habits over time. Building a strong credit history takes time. Responsible habits are key. Regularly reviewing your credit reports can help you spot errors and better understand your financial progress. Now let's avoid common credit mistakes before they become expensive. One biggest credit mistake is missing payment due dates. Even a single late payment can hurt your score. Using most of your available credit can make your finances look stretched than they actually are. Applying for several credit cards or loans within a short period may raise concerns for some lenders. So it's often better to apply only when needed. A common myth is that checking your own credit score always lowers it. In many cases, reviewing your own credit information does not have that effect. Another misconception is that you need large RIDI. Responsible use of credit is generally more important. Closing an older credit account may affect your overall understanding the impact before making that decision. Regularly monitoring your accounts helps identify suspicious activity. Simple habits like budgeting support our long-term financial success. Improving your credit profile is usually a gradual process. Small, consistent financial decisions can make a meaningful difference over time. Next, we'll see how your credit score can influence mortgages, auto loans, credit cards, apartment rentals, and even some everyday financial opportunities. When you apply for a mortgage, lenders look profile, along with your income, debts, and financial information, to help decide whether to approve your loan. Even a small difference can affect the total amount paid.
Credit information is considered when financing a vehicle. Better loan terms may be available to qualified borrowers. Issuers review your credit profile when deciding to approve. They also use it to determine what credit limit to offer.
Many landlords review credit information process, along with income, rental history, and other factors. Some utility or service providers may also consider credit information when determining deposits.
Responsible credit management can help build financial trust. Imagine two borrowers with similar incomes. Their loan offers may differ. Lenders evaluate overall financial risk.
Strong credit isn't built overnight. It develops through consistent, responsible financial habits practiced over months and years. In the final chapter, you'll learn practical strategies to strengthen your credit profile, avoid common pitfalls, and build a healthier financial future. The good news is that credit profiles over time. Consistent financial habits often make the biggest difference. Making every payment on time, automatic payments and reminders can help you stay on track. Keeping credit card balances manageable and paying more than the minimum whenever long-term financial habits. Reviewing your credit reports regularly identify errors, monitor progress, and better financial history. If you notice information that's inaccurate, follow the appropriate process to dispute it. Be cautious of companies that promise instant credit score improvements. Building strong credit takes time. A realistic monthly budget helps you manage spending, avoid unnecessary debt, and stay prepared. Good credit isn't about quick results. It's about smart decisions over many months and years. Remember the basics. Pay on time and borrow responsibly. Monitor your credit information. And continue learning about personal finance.
Thanks for watching. Subscribe to Future IQ for more videos on personal financial intelligence, business, and future technology. Your financial future starts with the knowledge you gain today.